Okay, get this. What if I told you that in November of 1963, the entire American stock market was almost brought to its knees by a tank of salad oil? Seriously, it's this incredible story where a massive financial fraud smacks right into a devastating national tragedy, creating a perfect storm that nearly wiped everything out.
I mean, just try to imagine this for a second. You find out that a multi-million dollar investment you've made is basically worthless. It's just a giant tank of water. And at the exact same moment, you get the news that the president has been assassinated. That's the collision we're talking about. It's this crisis of trust, see, built on an unbelievably clever lie that gets blown up by one of the darkest moments in the country's history. And it all kicked off, not with some big explosion, but with a quiet, panicked confession.
So let's set the scene. It's Tuesday, November 19th, 1963. Just another day on Wall Street, right? Well, not exactly. A partner from a pretty well-respected firm, Ira Hopton Company, walks into the New York Stock Exchange and basically drops a bomb. He confesses, we're broke. And the reason they're broke? They loaned a huge amount of money to just one client, a company called Allied that was in the vegetable oil business.
Okay, so to really get how a firm could just go broke like that, we gotta talk about something called collateral. You probably know this, but it's basically an asset you put up to secure a loan. If you can't pay, the lender takes the asset. Simple. And Allied wasn't just borrowing money based on a handshake and their reputation. Nope. They were using actual physical stuff, these enormous tanks that were supposed to be filled to the brim with valuable salad oil to get millions and millions in loans.
And on paper, the whole scam looked deceptively simple, almost elegant. So Allied would get these official-looking warehouse receipts, right? These are documents that legally prove the oil exists in those tanks. So lenders, like our friends at Ira Hopt, they'd see this paperwork and think, hey, this is a no-brainer. If they default, we just take the oil. It's totally foolproof. Yeah, that turned out to be a fatal assumption.
And here is the absolute genius of the deception. This is where it gets crazy. The guy behind it all, Anthony De Angelis, he had this brilliant, evil idea. He filled the tanks almost completely full with cheap seawater. Then he'd just pump in a few feet of real salad oil right on top. And, oil floats on water, so when the inspectors would show up to check, they'd dip their long measuring sticks in from the top, and what do you know? It comes up smelling of oil. They thought they were lending millions against oil, but they were actually lending against an entire ocean of salt water. Unbelievable.
So you can imagine the clock is ticking on this fraud. Wall Street is just starting to wrap its head around the sheer scale of this scam. But before they could even begin to process it, the nation's clock just stopped. On Friday, November 22nd, a crisis that was so much bigger hit the country.
And you know who got hit first? Wasn't the big banks. Not yet. When the New York Stock Exchange suspended Ira Hopt, it instantly froze the accounts of 20,000 of their clients. We're talking about everyday people, retail investors. Just boom, accounts frozen. They couldn't get their money, they couldn't sell their stocks. Their entire life savings were just hanging in the balance. Just look at how fast this all went down. On Tuesday, the fraud gets confessed. By Wednesday, those 20,000 accounts are frozen solid. All through Thursday, the panic is just building and building on Wall Street. And then Friday, at 1:40 in the afternoon, the news hits the floor of the stock exchange. President Kennedy has been shot. The reaction was just pure gut punch panic. The market didn't just dip, it completely seized up. Stocks went into free fall, wiping out a staggering 13 times $1 billion in value in just 30 minutes. 30 minutes! The chaos was so bad, the NYSE had no other choice. They had to close the market early just to stop the bleed. And right there, that's the double threat. This is what made it so dangerous. On one hand, you have this massive fraud that completely shatters people's trust in the financial system. Is anything real? And on the other hand, you have an assassination that shatters trust in the stability of the entire country. When you put those two crises of confidence together, you are staring right into the abyss of another Great Depression. So with a threat this big, the old rulebook was completely useless. You just had to throw it out the window. And that's when a man named Keith Funston, who was the president of the New York Stock Exchange back then, stepped up. He got it. He knew this wasn't about following the rules anymore. This was about saving the idea of the American market. And he had one incredibly somber weekend to figure out how to do it. And the plan he came up with, it was absolutely audacious. I mean, completely unheard of. He proposed that the New York Stock Exchange itself, the institution, should use its own money to make every single one of those 20,000 investors whole. Now, you have to remember, there was no law that said they had to do this. There was no SIPC insurance like we have today.
There was nothing. This was a totally voluntary move. But this idea created a huge standoff. See, legally, the big banks were first in line to get any money back from the bankrupt firm. So, of course, every bank CEO is thinking, my first duty is to my shareholders. We need to get our money back now. But Funston's pitch was brilliant. He called it enlightened self-interest. He basically told them, look, you can fight for your little piece of the pie right now, but if public trust in the entire system collapses, we all lose. Everything. And that's going to hurt you way more in the long run.
And the hurdles he had to clear were just immense. First, you had to get all these rival New York banks, who are usually at each other's throats, to cooperate. Then there was what they called the British problem. Turns out Haupt also owed millions to British banks. So an emergency team literally had to get on a plane to London during this weekend of intense national mourning and convince these super conservative British bankers to hold off on calling in their debts, which would have sunk the whole rescue plan.
So this whole thing becomes a desperate race against the clock. The negotiations are happening nonstop, all weekend long, while the entire country is glued to their TVs mourning the president. And all the while, that Tuesday morning opening bell is getting closer and closer. Literally everything was on the line. And they did it. In the dead of night, they finally got the deal. This incredibly complex agreement, signed off by all the big American and British banks, was secured. And get this, it was just 9 hours before the market was supposed to open. 9 hours. In the end, everybody walked away with less money than they were legally owed, but it didn't matter. They had saved the entire system. So Tuesday morning comes. The opening bell rings. And the NYSE makes the announcement immediately. They've committed $7.5 million of their own money to protect those 20,000 clients. They made good on their promise. Not one single regular investor lost a single penny. And what did the market do? Oh, the reaction was instant and just unbelievably positive. It was like a shot of pure confidence. People saw this act as proof that the system would protect them. That, combined with a renewed faith in the new president, caused the market to just surge. It recovered every single penny of that $13 billion that it lost on Friday in one day. The entire loss, erased. This whole incredible story, it really teaches us some deep lessons about what makes a market stable. It's not just about laws and regulations on a piece of paper. It's about something way more fundamental, something human. And it all comes back to Keith Funston's guiding principle. He understood something crucial, that confidence is the single most valuable asset in any market. The exchange didn't just spend $7.5 million. They spent a fortune they absolutely did not have to spend, for one reason and one reason only: to buy back public confidence. So what are the big takeaways here? Well, there are 3 really big ones. First, that trust is a kind of currency. Sometimes you literally have to spend money to buy it back. Second, remember how this all started? A failure of basic due diligence. The lesson? Verify. Don't just assume. And third, this was an amazing example of cooperation over competition. You had fierce rivals who decided to work together to protect the entire system from just falling apart.
You know, there's a perfect analogy for what the NYSE did, and it makes it super clear. Imagine you go to a theater, and the person working the coat check steals everyone's coats. Now, is the theater owner legally responsible for that? Probably not. But if that owner wants anyone to ever come back to his theater again, what does he do? He replaces all the coats out of his own pocket. That's exactly what the NYSE did for the market.
And when you boil it all down, this whole story demonstrates a really powerful idea: that a completely voluntary, incredibly expensive decision to protect individual investors was the one thing that stabilized the entire American market right when it was at its most fragile. Which kind of leaves us with one last, really interesting question to chew on. If a market can be saved by what is essentially spontaneous goodwill, driven by the powerful need to protect a reputation, what does that tell us about the true cost and maybe the efficiency of the government regulations and insurance programs that were created later to do the exact same thing? It's a fascinating thought, isn't it?